Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Good morning, everyone. Welcome to the inaugural Cormark-Corton Fund podcast. We'll walk you through some macro slides and talk a bit about the fund. So before we get to all that fun stuff, I have disclosures for compliance. So I'm Mark Deriet. I'm an officer and director of Cormark Quantitative Analysis, Inc., or CQA, which is a wholly owned subsidiary of Cormark Securities, Inc. CQA developed quantitative models that have been licensed to and implemented by Corton Capital, Inc., or Corton, which is the investment fund manager and portfolio manager of the Cormark-Corton Quantitative Opportunities Fund, and its underlying fund, Cormark-Corton Quantitative Opportunities Fund LP, each a related issuer of CSI and Corton. So with that, let's get to the fun stuff. So a bit about my background. I spent about 10 years on the buy side, mostly at Scotia, doing international equities and emerging markets. And I've been at Cormark for almost 20 years now, believe it or not. And I am lucky to be the #1 ranked quantitative and technical analyst based on a survey of institutional clients done by Brendan Wood. So some macro indicators. We have this, try to keep it simple, these kind of red lights and green lights for 13 key indicators that we watch. And quite simply, we've got a lot of green lights here. So we separate them into 4 buckets, whether you're in a bull trend or a bear trend, and you can see most of the indicators that we have are flashing green. We'll go through some of these in detail. So firstly, our favorite equity index to monitor is the Global Equally Weighted Index. And rather than being market cap weighted and dominated by the Mag 7 and so on, this is equally weighted, 3,000 stocks roughly around the world. Got a much bigger weight to China, around 20%, so the US doesn't dominate. And the trend of this indicator, this index, was under pressure in the spring, just like the S&P, but it snapped back earlier. It flipped positive in May and just made an all-time high. So clearly that's a bull trend until proven otherwise. It has gone a long way, so maybe we need some backing and filling, but certainly a green light for global equities. The S&P was a bit lagging off the lows in terms of making a new high, but that joined the party as well. And the next upside we're looking for is 6,650 and towards 7,000. And we wanted to highlight this indicator at the bottom. This is called an RSI, which is just an oscillator from 0 to 100. And we always say our tagline when looking at charts is to embrace strength and fear weakness. So we consider strength above 60 when this indicator pushes above 60 for the first time, which we've circled here in green. Fear weakness when it goes below 40 for the first time. So we've back tested this since 1896 for both the Dow and then the S&P. And you can see the subsequent return after this indicator is able to push above 60 is 21% over 20 months. So it's essentially confirmation of a new cyclical bull market, and that just happened in June. You can see the returns when it goes below 40. The average drawdown is quite significant, almost 19%, and it takes about 11 months for it to get back into a bull mode. And we've put here, the distance between these green circles. So, our base case is that we've started a new cyclical bull after the reset in the spring. Now, tactically, we have a number of indicators that we track that, not surprising, got quite depressed in April. And several weeks ago was the opposite. Think about this as a rubber band. So the rubber band got pushed quite aggressively to the upside, and now it's coming off the boil. And you look at these little tables at the bottom, the subsequent 1 to 3 month returns are subpar when we're in this mode. So essentially, we're looking for some sort of a consolidation or correction within an uptrend. Breadth measures. So we look at a lot of different breadth indicators. The one on the left for the S&P shows a longer term measure. And you can see that that got reasonably depressed in April. It's been gaining steam ever since. And importantly, it has further room to run. So if you think about it, there's more fuel in the tank for more stocks to enter bull markets or bull trends. Typically, this peaks north of 80%. A shorter term measure on the right did get fairly stretched and has started to come off the boil, kind of supporting a corrective phase. So even though the market has made new highs recently, shorter term breadth has not confirmed. Another simple breadth measure we look at is the percent in the Russell 3000, so a very broad list of stocks that are making either new lows in red or new highs in green. So we can see the green bars have been expanding here, more new highs. It's not yet at an extreme, north of 20% would be kind of a buying climax potentially. We're not there yet. And then we look at this red bar for warning signs. If this indicator breaks below 10%, that typically means that underneath the hood, there's more damage than we'd like. And you can see that happen, for instance, in November of 21, and then the market peaked in Jan of 22. It happened in February of 2018, and then the market fell apart in Q4 of 18, happened in middle of 2014, and then we had trouble in 2015, et cetera. So we don't see any warning signs from this breadth indicator, which we track quite frequently. This is a risk appetite. We call it our baker's dozen of risk trades. So there's 13 indicators here, all rolled into this one chart, looking at risk trades across currencies, commodities, bonds, and equities. And it's in a bull trend. It's also correcting lately, even though the market's making new highs. So, suggests a pullback as well. The credit market is part of that risk appetite gauge, that baker's dozen. And here in red, we show credit spreads, but inverted. The gray line behind it is the S&P. And the blue line, the candles, are that global equally weighted index. So typically, not always, unfortunately, but typically you get a warning sign with the credit market deteriorating ahead of the S&P. You can see I've marked with arrows where that red line starts to go down, the S&P is still rising. The average stock, that global equally weighted index, also starts to turn down ahead of the S&P. So we don't see those warning signs currently. Turning to factors, we're noting that the momentum factor and high beta are starting to slip on our rankings here. So on this schematic, we have the x-axis is a long-term score in terms of price momentum and a short-term score on the y-axis. The idea is that you embrace strength in the sunshine in the upper right, fear weakness in the lower left, and you tend to rotate clockwise. So momentum is losing a bit of steam on a relative basis. We show that on this slide. This is the one momentum ETF in Canada, WXM, and we're showing it relative to the market. So as it's going down, it's starting to underperform. You can see it's slipping over the near term as well. And then the other pair we look at in terms of factors quite closely is beta versus low volatility. And this is a rubber band, if you will, indicator for that ratio. You can see that in April, that rubber band was as depressed as it was during COVID, believe it or not. And then we've got the opposite scenario now. We've had this huge run up in beta to low vol. And that rubber band is very, very stretched to the upside and starting to come in. So this is other evidence of a possible pullback in the marketplace. Turning to sector rotation, this is a basket of cyclical areas, industrials, tech, and discretionary, all relative to defensive staples, healthcare, and utilities. So this too has kind of been correcting or going sideways over the last several weeks. Still in a bull trend, but the same sort of story is being given by that indicator. We have the same sun rain chart for sectors in North America. In the sunshine currently are golds, discretionary, and financials. And in the rain, healthcare, REITs, materials, staples. So it is pointing to cyclicality from a bigger picture point of view. Turning to some macro slides, we do have a master's in economics. Not that I would want to be an economist by trade, but we do follow some of these indicators. And there's been a real divergence between what they call the soft data and the hard data. So the soft data, the red and black lines here, are surveys of how people feel. Are they bullish on the prospects for the economy? These gave negative sort of recessionary signals way back in the middle of 22, and we're still waiting for Godot. We haven't seen recession yet. The blue line is the hard data. This is called the Fed Weekly Economic Index, and it has things like gasoline sales, electricity usage, retail sales, etc. And that's been holding up very well. So until that falters, we're not calling for a recession, despite how people feel. And then the blue line here is a basket of 8 labor market indicators, and it's all normalized. You can see, during COVID, it obviously jumped off a cliff. It was very depressed, almost as bad as the great financial crisis. And then it snapped back with a vengeance and got to, record highs in terms of how tight the labor market is. And you can see it's certainly deteriorating, so there's weakness there, but it's not collapsing. Below zero, this black line is typically where it gets into recession territory, and we're still 0.9 standard deviations above the mean. So again, no recession yet, and that should, cause earnings to maybe carry the ball for the S&P as well. And then the Fed, 2 cents on the Fed. I always say, look at what the 2-year bond yield is doing, which is in blue, to dictate what the Fed funds will do, which is in red. So the bond market drives the bus essentially, not the Fed. And when the 2-year falls below the Fed funds, lo and behold, they usually stop hiking, and eventually, as that spread widens, the Fed cuts rates. So the bond market is pricing in 3 cuts, and if we don't have a recession, that should be supportive of valuations. Turning to the current status of the fund, in terms of sectors, we have the biggest overweight now in golds and industrials. You can see 20% each, and the third biggest weight is financials. We're underweight the sector. It's a very big sector in Canada, but that's our third biggest exposure. We like to group the sectors into kind of 4 buckets as well. Resources, we're overweight, largely due to the golds. Industrials, tech, and discretionary tend to act similarly. We're a little bit overweight there. Defense, we're neutral. We had been large underweight defense, but given that our tactical indicators have been all stretched, we've increased exposure to that area. And then financials, the big banks represent 20% of the market, and the fund wants to be not aligned with the index necessarily. We want to be differentiated from the index, so we'll be chronically underweight financials. We have about 4% cash. We have a market short position of 6.5%. Just again, given the big run that the market has had, we want to have some protection there. And our portfolio beta has been reduced to about 0.87 recently. It was running hot at about 1.2 about 6 weeks ago or so. We have a very high active share, and we'll get into what that means at 93% on the next slide. I'll define that. We'll always have significant exposure to small and mid-cap stocks to differentiate ourselves from the index. So we have about 2/3 currently exposure to small and mid-cap. It was larger, frankly. We've taken some of that risk out and put it into bigger cap stocks recently. So this active share concept, we have some Venn diagrams to show what this means. So it's basically showing how differentiated you are versus the benchmark, which in our case is the TSX. So if we were out here on the right and the fund had nothing at all to do with the TSX index, no overlap at all, that would be 100% active share. Recall that we're currently 93%. Our goal is kind of north of 75%. The average fund in Canada has a 50% overlap with the index. If you were a complete index fund, then you would have 0 active share. So we're trying to not hug the index, and that's a key differentiator to us. We will have long and short exposure. A lot of exposure to small to mid caps, as I said. Big sector bets. Our biggest gain is the golds right now, and that's about 2 times the index weight, 20% versus 10% of the benchmark. And then try to focus on downside protection. So we have macro indicators and lots of market indicators that will dictate the overall net exposure of the fund. In terms of some screens, we have our what we call our quant stars. This is the tables, the two tables on the left. Again, riddled with gold stocks and lots of industrials. This is what's driving kind of bottom up our sector weightings. And then we also have a value sleeve. So that's on the far right table. So value, if you combine both value and our quant and momentum work, they act as kind of a yin yang, if you will, and they act quite differently. So when you merge the two together into a portfolio, you get diversification benefits, and that's why we have a value sleeve to our fund as well. And then turning to the momentum factor, we think we have a unique take on it. Typically, momentum players focus only on one time frame, the longer term time frame, which here in the sun rain chart again is delineated on the x-axis. We combine two time frames, the x-axis long term and the short term on the y-axis, and then you can enter positions earlier. So we're looking for fresh money ideas in this improving camp, and also exit stocks earlier before they're in the rain. So we look to exit when they get into this weakening camp. So some recent trades that we've put on, about a month ago, we bought a value pick, Adentra. It's in the home building products area. U.S. home builder is starting to percolate on our ETF momentum scores. This tends to have a very high correlation to U.S. home builders. And the valuation score was 1 out of 10, meaning that it was very cheap. And the momentum was starting to improve. So we bought it about a month ago, and luckily they came in with a positive earnings surprise. So our quant ranking ramped up after that. That's the yellow line on this left chart. So that's a recent value pick. In terms of the golds, we said that's our number one weighting now, and we recently bought Alamos Gold. So when we started the fund in first or second week of May, a lot of the gold stocks were running really hot. Again, that rubber band concept idea, this momentum indicator on the bottom right of Alamos Gold chart was very, very stretched to the upside. So we were actually underweight golds coming out of the gate. And Alamos in particular, the momentum got depressed and started to hook up, and it came back to support. So we're looking at timing as well. So we've added Alamos to our fund recently. And then a couple of trims. So we still own these stocks, but again, running too hot. So Celestica ranks number 9 out of 670 stocks on our quantitative model. Very, very strong, obviously. But again, that rubber band idea got very, very stretched. So we reduced Celestica recently, still have a position, but reduced it. And 5N Plus was another stock, number 3 overall on our quant work. So very, very strong. But again, running too hot. You can see the stock had a huge move here recently. So we've trimmed that. So this is just a bit of our fund history performance. Obviously, very, very early days. So not a whole lot to comment on the performance. It's only been kind of 2.5 months. The top contributors month to date are Adentra, which we mentioned we recently bought, MDA and VNP. And the holdbacks or detractors of performance, Topicus, VitalHub, and Kinaxis. I'd also like to mention that Corton Capital is launching a new product specifically for disabled people called the Corton Capital Registered Disability Savings Plan. Here to provide more information about the plan is Brenda K10. Over to you, Brenda.
Thank you. I'm Brenda Catan, manager of the RDSP investment program at Corton Capital, and I've been working to get disability benefits for Canadians for over a decade. Do you or someone in your family have a disability? Corton Capital can help. We specialize in the Registered Disability Savings Plan and can help you open an RDSP if you're eligible for the disability tax credit, are 59 years of age or younger, have a social insurance number, and are a Canadian resident. Most financial institutions leave the guesswork to you and offer completely self-directed RDSPs. Our comprehensive RDSP management program takes care of everything, from setting up your account to maximizing government entitlements, comprehensive portfolio management, and strategic contribution planning. We'll also help you receive up to $90,000 in entitlements from the government. Secure your financial future today. Visit us at rdsp.cortoncapital.ca or call us at 1-888-334-0033 to get started.
Thank you, Brenda. And thanks everyone for your time. And if you're interested in investing in the Quant Fund, please reach out to myself or David Jarvis at Corton Capital. Our information is provided here. Take care.